Hi, everybody. Welcome with Coffee with the Buzz. How to find explosive stocks using my TPS strategy. Um, you know, so I've invested a lot of time and money testing different strategies, and believe me, you could spend a lifetime and still not run through them all. However, I started to pick up on a common theme after studying the traits of the best traders out there. One strategy that I was drawn to, and I still am to this day, is trend trading. It's when you go with the flow. In other words, if a stock or ETF is trading higher, instead of fighting it, I want to join in and try to ride the wave up. Trading with trends is like swimming with the ocean current. It's not just easier, it's more predictable. It took me a while to wrap my mind around the intricacies of trend trading. I always seem to identify them after the fact. I enter trades at the late stages of a trend and never seemed to make enough to justify the risk I was taking, or the stock would turn down and I would end up taking small losses. And it gets frustrating. You're just late to the party all the time. So how can you identify when a stock is getting ready to make an explosive move? And that's where I've developed the trend pattern and squeeze, the TPS strategy. So I'm looking for a trend that must be moving up on a daily chart time frame from the bottom left to the upper right. I think everybody understands what a trend is, okay? And then I'm looking for a pattern that has just made a recent 52-week high, okay? You can see over here on the right side of the screen with these red lines. This is the pattern that I play. Some of you might already know what this is, but if you don't, it's called a bull flag pattern, okay? This is our trend upward, which is the pole, and then this is the flag part of the stock. I prefer that it holds above the 21-day moving average and below the 8-day moving average. It's going to bounce around here above and below it, but I like to see it stay pretty consistent there. The next thing I look for is the squeeze. That's the S in the TPS squeeze strategy. So I'm looking for a squeeze, which is indicated here by red dots. Okay, this shows me that there is a consolidation of a stock, and there is energy building, and it's getting ready. What this part tells me, it's getting ready to move up or down. Okay, the reason I apply this to this pattern, a bull flag is usually a continuation pattern, so it usually means it's getting ready to take off. But a lot of times, this pattern, it doesn't tell you when it's going to take off. I mean, you could be back here, say, oh, I'm in here, and next thing you know, you're waiting, and this could go on for another week or 2 weeks. While this indicator here gives me a chance to get in before the move starts and not too early. So, going on, just real brief, this is what a trend is. From left to right, it should be building and gaining, not jumping up and down. So if everybody here can agree, this is pretty clear of a trend that's moving up. The next is the P, okay? The one thing that I'm looking for is this pattern here. I can show this pattern or this chart to multiple people and they might find multiple patterns, but for me, this is the pattern I see. And if you look before here, made a recent high and now it's pulled back and consolidated. The consolidation can be thought more of an area of rest within the chart. So you got to think about it as a sprinter who just gave his all in the 400-meter dash. He just sprinted all the way up here, race is over. He needs a little breather right here before he can go on to his next race. Stocks are the same way. So I'm looking for a stock that has sprinted upward and is resting, consolidating for its next move higher, and is looking for a continuation. So let's take a peek at what this looks like with a squeeze. Okay, you can see this is the same exact chart, and before this move here, you've got red dots, red squeezes here, which is indicating it's consolidating and getting ready to make a move up or down. Okay, now we're using this as well to predict the move is up. Okay, and you can see right as this fires, we have a big move up in one day and then a continuation thereafter. You know, consolidation periods can last for hours, days, or weeks. So, you know, this squeeze indicator is really a big discovery for me. Probably the most significant discovery since I've been trading. It turned me from, you know, breaking even as a trader to consistently profitable, because it allows me to master the timing of a move. You know, people ask me all the time, how do you know that stock's getting ready to move? Well, that's the indicator that tells me that. It's the key. So, you know, moving on from there, talk a little bit about what a bull flag pattern is. I've mentioned it a few times. If you guys want to pause the video and read through this, I'm not going to read this whole page. And then there's also over here, you can see there's called a pennant flag pattern, which is when it comes to a point, like in this diagram down here. So go ahead and read through that. You can pause it and read through. Both the bull flag and the pennant flag are both very good patterns to play. Again, this is just a little bit more on what a bull flag is. Go ahead and pause the video and read through this. But I want to talk about, you know, you're using these patterns to find an ideal entry point, and we will go through that on a later slide on how I'm timing my entry point. Once I find a trade that's getting ready to move, getting in it is just as important as the exit. Okay, and that's, again, you want to plan for the exit. Before you buy a stock, you need to know where your exit is going to be, and have a good, reasonable strategy up to that. Trading the first bull flag is also very important. Many traders will also trade the very first bull flag, but what you don't realize is there's also going to be second and third flags that you can play for even bigger moves, and you can really get, if you get good at this, really get some big returns fairly easy. And then talk about right here practicing with paper trades. I don't recommend anybody jumps right into this with their money. I think you should go ahead and practice paper trading until you see a consistent return and that you feel comfortable doing this on your own. You know, it's anytime you're doing a new strategy, you should do it only on paper for a while. Next, I describe here, you can read through this, pausing the video, you can read through this, and talks about different ways, or the way that I do my scans in the morning. You know, but any trader is going to look for a stock that's going to meet their trading style. And you also want to find setups before they have a chance to play out, and that's what we use the squeeze indicator for. And the next thing you want to look for is a stock that has enough liquidity that you can easily get in and out of trades, and that the spreads are not too wide, so that you're not, you know, chasing an exit price. And again, you'll be happy to know I use FinViz, and it's completely free. My next slide here talks about what I do. My first scan of the day, I do a price. It's over $15. A float short, I'm looking for at least 15% short float. I want a stock that's within 10% of a 52-week high, and I want an average volume of at least 100,000. Now, sometimes I'll pull this up and there'll be 56, 57, you know, 70 stocks that I got to go through, and I'll start fine tuning this. So what I'll do is I'll turn the average volume up, maybe to 500,000 or 1 million. I'll take the short float and I'll turn that up to 20%, 25%, or even the price, because even the higher price stocks are going to be more volatile and give you better returns. So sometimes I'll turn that up to about $30. And then vice versa. If I have a day where not a lot showing up, maybe I turn the short float down to 10%. I don't like to go below 15, and I like to keep these here, but if I'm having a day where there's not a lot coming up, I will drop this down to about 10%. The lower the short float, the less the move is going to probably be. And if you understand what short float is and how it affects a stock when the shorts begin to cover, go ahead and look at GME. That's a perfect example. Next up, this is my perfect setup. Okay, this is an excellent chart right here. You've got your pole of the flag, your uptrend, then you have your pattern, the bull flag. Last up, you have the squeeze with these red dots, and you can see immediately where it fires, and this stock takes off for a big run up. Next up, we're going to go into what exactly is the TTM squeeze. You guys can read about this a little more on Google, but it's basically a technical indicator that determines if the market is in a consolidation period or if it's about to break out and move in one direction or another. Be careful of this because one direction or another, it could go up or down. And that's why you have to use this with a stock that's trending up, again, swimming with the current, and then also with the bull pattern, the bull flag pattern, because that's usually a continuation pattern. So using those two things together with this telling us when it's getting ready to fire, you can see the red dot, it fired, and then it went into consolidation right here, and now it's under squeeze, and then it just fired over here. So you really need to learn about this, and you can read online a little bit more, and I will do other videos as well just on what the TTM squeeze is. But once you do your scan in the morning and you find the stocks that are candidates and you find, okay, they meet my conditions, now you need to look at a entry point. I look at stocks that are stacked. The moving averages must be stacked. So the 200-day moving average is this dotted line here. My 21-day is here, and my 8-day is here. They must be in order for me to play this stock. I was watching Dick's Sporting Goods last week for quite a long time. I actually played it. You can't see it on this part of the chart, but previously I was playing it up into this move right here, and then it pulled back. So it was too low. It was below the 21-day moving average. So I was not buying it, but I was watching it, and then it moved above the 8-day moving average, so I was still waiting, okay? It was not until it reached right here, and this was now in my buy zone, that I entered this trade to ride up, and you can't see off this with this slide here, but there is a new 52-week high. This dotted line right here was the previous 52-week high, and then it just made this high on Friday. Today, by the way, is March 21st, so we'll see tomorrow, Monday, if Dick's Sporting Goods goes ahead and continues going long on the high side. I think it will. I've already exited the trade with a 240% win, but that one there is a great example of getting into the buy zone, riding it up to the new high, okay? So, again, it's like the Goldilocks zone right here. This is your buy zone. I've colored it in between my averages so you can see it. This is not, it's too high. If you get in here and it keeps running, great. But a lot of times you'll get in, or like, let's say, for instance, you're like, oh, I think this is a great time. We're in a squeeze. I jump in here and it pulls back. Well, now, yes, could you be profitable when it hits the 52-week high? Yes, you probably will be. But I'm much more profitable waiting and being patient for it to pull back into my buy zone and waiting for the options to, you have implied volatility. So when stocks are moving up, the implied volatility goes up a lot and you're paying a premium for those options. If you wait for it to pull back, you're getting a better rate on your options for it to move up, and then volatility moves up and you get a bigger profit for your risk. My last slide here talks about the checklist that I do before I buy a stock. You guys can go ahead and read through all these things. It's just what we went through just now. And you guys need to learn how to do an exit strategy. I personally am looking to break a 52-week high. So this would be my exit strategy, anything above this. I'm buying here. I know it's going to probably go up and break a new high. So as soon as it does, that's my exit. Once it makes that new high, it could easily pull back on Monday, or it could continue, but I've already made my money and I'm out. If at any time right here, the stock moves below the 21-day moving average. If you've entered it in the trade, you were in the buy zone, and it pulls back below the 21-day moving average at any time, close your position. No emotion. The stock moves back into the buy zone, go ahead and get back in it. As long as everything still fits it. So if I would have bought right here and tomorrow it opened down here, I'm exiting the trade. I'm out. I will take my 10% loss or 15% loss or whatever it is, and I'm out. If it moves back up into my buy zone, I'll just jump right back in and ride the wave back up. But you just that's your exit strategy right there. Your 21-day moving average is your exit strategy at all times. But if you do get out, go ahead and start back at the top of this and make sure that all these things still fit your buy, to make sure that every one of these are checked off and that you can still get back in. If you happen to it breaks short and now all of a sudden you no longer have a squeeze, this check isn't valid, so move on to another stock. This chart is now broken and it's time to move on to something else. So yeah, just don't get greedy, guys. You're gonna do well if you can stick to the rules on this, and I hope you guys have learned something here. And if you have any questions, go ahead and post them down below. I will definitely respond and comment, and I want everybody to be successful here. Have a good day, and let's see what happens on Monday. Good luck, guys.